What if the biggest threat to Tesla never actually stood a chance? For years, the electric vehicle revolution has been framed like a Hollywood story. A single dominant player rises to the top. And then, inevitably, challengers emerge. Faster, smarter, leaner, each one promising to dethrone the king. Investors poured in billions. Headlines hyped them as the future. Social media crowned them Tesla killers. And yet, here we are in 2026, looking at a very different reality. Many of those once promising electric vehicle startups are now bankrupt, collapsing, or quietly fading into irrelevance. The bold promises have turned into missed deadlines, the flashy prototypes into unfinished production lines, the billion-dollar valuations into cautionary tales. Welcome to the EV graveyard, where ambition met reality, and reality won. To understand why so many of these companies failed, you have to go back to the early 2020s, a time when the electric vehicle market felt like the Wild West. Tesla had proven that electric cars could be desirable, fast, and profitable. More importantly, it showed that the future of transportation was undeniably electric. Governments pushed for EV adoption, consumers became more environmentally conscious, capital was cheap, and investors were hungry for the next big thing. That created the perfect storm. Suddenly, startups began appearing everywhere, each with a compelling story. Some focused on luxury electric sedans, others targeted rugged electric trucks. A few aimed to reinvent mobility entirely, but they all shared one thing: the promise that they could do what Tesla did, only better. And for a while, people believed it. Many of these companies went public through SPAC deals, bypassing the traditional IPO process. This allowed them to raise massive amounts of money quickly, often based on projections rather than actual results. It wasn't unusual for a company with zero production vehicles to be valued in the billions. In hindsight, it almost seems inevitable what happened next. At first glance, everything looked impressive: sleek concept vehicles, futuristic interiors, long-range batteries, cutting-edge software. Carefully produced promotional videos made it seem like these companies were on the verge of changing the world. But there's a crucial difference between building a prototype and building a product. A prototype only needs to work once. A real car needs to work every day, in every condition, for years, and be manufactured at scale, profitably. This is where the illusion started to crack. Many startups underestimated the sheer complexity of automotive manufacturing. It's not just about engineering a great car. It's about supply chains, logistics, quality control, regulatory compliance, service networks, and cost management, all operating in perfect synchronization. Even small issues can cause massive delays. A single missing component can halt an entire production line. A minor design flaw can require costly recalls. And when you're burning millions of dollars a day, time is not on your side. The automotive industry is one of the most capital-intensive industries in the world. Factories cost billions to build and equip. Tooling, robotics, and assembly lines require enormous upfront investment. And unlike software, where products can be scaled at near zero marginal cost, physical manufacturing comes with constant expenses. Every car built has a cost: materials, labor, logistics, and in the early stages, those costs are often higher than the selling price. This is normal. Even Tesla went through what many called production hell, nearly running out of cash in the process. But Tesla survived long enough to scale. Most startups didn't. They ran into a deadly combination of factors. Rising interest rates made capital more expensive. Supply chain disruptions increased costs and caused delays. Inflation drove up the price of raw materials, especially batteries. Investor sentiment shifted from growth at all costs to profitability. Suddenly, the easy money disappeared, and without continuous funding, these companies began to collapse. Another major issue was credibility. To attract investors and media attention, many startups made aggressive promises. Production timelines were optimistic, performance specs were ambitious, pricing targets were often unrealistic. At first, this worked. Bold visions generate excitement. But when deadlines started slipping, trust eroded quickly. A delay of a few months turned into a year. Then another. Vehicles that were supposed to hit the market never arrived. Features that were advertised as revolutionary were quietly removed or postponed. Each missed promise made it harder to raise new funding. Each funding round came with worse terms. Eventually, the cycle became unsustainable. In an industry where execution is everything, credibility is currency. And once it's gone, it's almost impossible to recover. Perhaps the biggest mistake these startups made was underestimating how difficult it is to manufacture cars at scale. Tesla itself almost failed multiple times while learning this lesson. Building a car is not like building an app. You can't just push an update overnight to fix problems. Physical defects require physical solutions, and those are expensive and time-consuming. Legacy automakers have decades of experience in this area. They know how to optimize assembly lines, manage suppliers, and maintain quality at scale. Startups, on the other hand, often had to learn everything from scratch. Some tried to outsource manufacturing, which created its own set of challenges. Others attempted to build their own factories, leading to delays, cost overruns, and operational headaches. The result? Production bottlenecks, inconsistent quality, and mounting losses. There was also a flawed assumption underlying many business plans, that demand for electric vehicles would grow endlessly, and that any company that could produce an EV would find buyers. Reality turned out to be more nuanced. While EV adoption did increase, it wasn't uniform across all segments. High prices, limited charging infrastructure in some regions, and consumer hesitation slowed growth in certain markets. At the same time, competition intensified. Tesla continued to dominate key segments. Traditional automakers entered the EV space aggressively, and suddenly, consumers had more choices, often from brands they already trusted. This made it much harder for new entrants to gain traction. It's easy to look at Tesla today and focus on its products or its brand, but its real advantage is something less visible: experience. Tesla has already gone through the hardest phase, the phase that destroys most startups. It has built factories, optimized production, navigated supply chain challenges, and scaled globally. It has made mistakes, learned from them, and improved. In other words, Tesla has already survived the nightmare. New entrants weren't competing with Tesla at its beginning. They were competing with Tesla after it had already overcome the most difficult obstacles. That's a completely different challenge. While many startups struggled or failed, something else was happening in the background. Traditional automakers, companies that had been building cars for decades, began to fully commit to electric vehicles. These companies have enormous advantages: established manufacturing infrastructure, global supply chains, strong relationships with suppliers, brand recognition and customer trust, the ability to absorb losses during transition periods. They may have been slower to start, but once they committed, they moved with scale and efficiency. This fundamentally changed the competitive landscape. The question is no longer which startup will beat Tesla. It's how will Tesla compete against an entire industry transforming itself. What we're witnessing in 2026 is a classic market shakeout. In the early stages of any new industry, there is an explosion of innovation and competition. Dozens, sometimes hundreds of companies enter the space, each trying a different approach. Over time, reality sets in. Costs rise, competition intensifies, weak players are eliminated, strong players consolidate their positions. This is not unique to electric vehicles. It has happened in industries ranging from automobiles in the early 20th century to tech startups in the dot-com era. The EV industry is simply going through the same process. The fall of so many Tesla killers offers several important lessons. First, hype is not a substitute for execution. A compelling vision can attract attention and funding, but it cannot replace the hard work of building and scaling a real product. Second, manufacturing matters. In industries that involve physical products, operational excellence is just as important as innovation. Third, capital is not infinite. Even billions of dollars can disappear quickly if a business model is not sustainable. And finally, timing is everything. Entering a market too early comes with risks, but entering too late, when competition is already established, can be just as dangerous. Perhaps the biggest misconception of all was the idea that there would be a single company that would kill Tesla. That's not how industries work. Tesla doesn't need to be defeated by one competitor. Instead, it faces pressure from all sides: other EV manufacturers, traditional automakers, technological shifts, and changing consumer preferences. The future of the EV market is not a winner-takes-all scenario. It's a complex, competitive ecosystem. The dream of the Tesla killer wasn't entirely wrong. It just evolved. Instead of one company rising to challenge Tesla, we're seeing a broader transformation of the entire automotive industry. Electric vehicles are no longer a niche. They are the new standard. But for many startups that tried to ride the wave, the outcome has been harsh. Ambition alone wasn't enough. Funding wasn't enough. Even innovation wasn't enough. Because in the end, the EV revolution wasn't just about ideas. It was about execution. And in 2026, that's the line that separated the survivors from the ghosts in the EV graveyard.